Hi, it is David, the founder of Macrodesiac and chief doer here. I'm glad the weekend has kind of come and I guess gone. I'm doing this on Sunday morning because I've needed a break considering, the last seven days of action in the markets with the whole GameStop, Robinhood, all of this kind of mania that's going on. And I think I wanted to touch on that a little bit because it seems like there's a lot of information or misinformation going around. So just to lay the kind of groundwork, back at the start of Jan, we saw GameStop trading between kind of $10 and $20. As of right now, the market price is $328.24. That was the closing price on Friday evening. Now, how did we get here? So there was an extremely large short interest on the stock, nearing just over 100% at one point. Now, obviously, if the price is pushing up heavily, then those parties that are short in the market, their risk limits are going to start getting hit. And so they then have to cover their position, which induces more buying pressure and leads to a broader squeeze. Now, alongside that, you've also got what's known as gamma hedging. So what happens there is that because a lot of the buying of GameStop was actually done via call options, which is a derivative. It essentially means that as the price of the option approaches the strike price, or they become more in the money, the dealers have to then hedge their positions. So those who are on the other side of the writing of the call option have to hedge their positions, which means that they have to buy more shares of the underlying, because obviously options are a derivative, so you don't actually own the actual shares. So that then leads to even more buying pressure. And as we've seen, the price has gone about 1,700%. But off the back of that, misinformation has come in, I think, with people not understanding the role of different parties in the market. Okay, so people are getting angry at Robinhood and other brokers for, preventing trading and things like that, saying that, oh, you're bailing out the hedge funds and the shorters. It's not that at all. Okay, this decision comes from the very, very top, which are central counterparty clearing houses. Okay, so at the end of the day, to ensure that a trade is settled adequately, you need to have someone kind of sitting in the middle saying, okay, yeah, we can do that. We can allow this to function. Now, brokers have to post collateral based on various different metrics, but mainly to do with the kind of the size of the holdings, let's put it that way, on any one day, and they do this daily. So you can imagine the amount of buying pressure from retail traders. Okay, this has led to a hell of a lot of risk being built up in the market. So the central clearing parties basically said, which is DTCC, and underneath them the National Securities Clearing Corporation, they basically said, okay, we need 10 times more collateral than you usually post. Now, this is purely to protect the system. And if they weren't to have done this and things would have gone belly up, basically, you would have heard stories about, well, why didn't the regulation step in? Why did we allow this to happen? So it's purely to protect the system. And yeah, it's not fun that you can't, keep buying and keep the party going. But at the end of the day, if everything did go bottoms up because of retail traders, the blame would have been placed firmly at the retail traders, and institutions would have got off scot-free. So, you kind of have to understand the plumbing of the market before you can make comments about it being some kind of protection for the big guy. Right, let's get on to what I really wanted to talk about today, which is US 10-year yield and NQ, which I have put here. Okay, so what we saw last week was bonds actually turning bid, and we wrote a piece or did a video a couple of weeks ago explaining that we didn't think that the inflation story was very valid, and it was based off of looking at a longer term function of the market. So we ran a linear regression of 20 odd years, I think it was, maybe 21. No, it's 20 years. And we saw that the market was really approaching this mean level here. Okay, this middle line is the mean of all of this data here. So it's basically the average of the data. Okay, and when you start to see data returning to the average, you call it mean reversion. And one of two things is likely to happen there. It's likely to hit and bounce down, or it's likely to completely follow through. Now, you have to look at this from a probabilistic kind of outcome. The last 10 years, we've seen central banks just pumping liquidity into the market, specifically in this case, the Fed. And we've seen this yield just completely lower. And, you know, you could even go back decades to see that really the long-term downtrend for the US 10-year yield, or the risk-free rate of return, is, down. So we get to this point, which is the 20-year mean. Okay, what are we going to say to ourselves? Are we likely to push higher, especially when we start to consider the context of, you know, needing more stimulus, the pandemic, growth prospects being delayed? Or are we likely to just see that stimulus feed down into lower yields? I mean, this is the trade that we're looking at there, is lower really. So bonds bid, so you buy bonds, expecting yields to head down. Now, interestingly, what we saw at the same time was this move here in the NASDAQ. This is NASDAQ futures here, okay? So we saw this kind of collapse from when bonds started to turn bid up here on the 12th of Jan. We saw a kind of lag in the NASDAQ, but it seemed to me like it was blowing off a tiny bit. Now, something that I want to bring to your attention is this. Let me see if I can get it over onto the screen. Okay, so I've grabbed this from my Reuters terminal. And what this is showing is you can read the headline: overnight Shanghai interbank offered rate, or SHIBOR, rises to 3.282%, the highest since March the 20th. And I think that it's got even higher just over the weekend. I think someone said that it's got to 10%, but I'd need to validate that first. Now, what this is showing is the credit worthiness of Chinese banks. Okay, it's showing the cost of borrowing between Chinese banks. So they loan to each other on a daily basis to, you know, enable credit to essentially flow and to, you know, increase reserves at different banks, and basically just to earn a return in the short term. All right. Now, what this really means as it's rising is that banks are less willing to lend to each other. Okay. So there's different forms of risk in the market, right? You've got credit risk, you've got liquidity risk, you've got market risk, operational risk, and pretty much at the top is systemic risk. Okay. Here we're really talking about probably liquidity risk and credit risk. Okay. If Chinese banks don't want to lend to each other, credit can't flow through the economy, and things start to get kind of bottlenecked. All right. And this is going against probably the PBOC's, the People's Bank of China's sort of policy. They need credit to be flowing nicely for the economy to work, for markets to stay up, for really their asset prices to remain elevated. And in China, the asset prices are really focused in on the housing market. That's recently where their GDP growth has come from. And so piecing those two things together, specifically with regards to the housing market in China and this recent piece of data, I don't think everything's so rosy in China. And if we're looking at the recent move in the NASDAQ, okay, I do think that there's the potential for a broader move down here, specifically if yields do start continuing on this downward trajectory. Okay, the bond market normally tells everything. And we've really got to bear that in mind with pretty much every single trading decision that we make for the longer term. I know if you're a scalper or, you know, a day trader, potentially it doesn't matter as much. But if you're looking at a longer term position and you're looking at a macro viewpoint, then that's really key. So this week I'm looking at a bit of a risk off week, to be honest with you. I think There's the broader potential as well for the dollar to start making a comeback. We know that the dollar has been heavily shorted over the last sort of 6 to 9 months, and you could start making a case for there being some sort of bottoming pattern here. Okay, you've got a bit of a support level there where we've broken above. You can see that we traded this price here and really just started to come off. So this is the dollar index. Now, if you were to translate this into the euro, it looks very similar. Okay, you've still got this this sort of pattern here. That would be the inverse on the dollar index. And really where you're looking for your key level is this one. Okay, so that 120.50, 120.60 is really where you should be looking to try and attempt to get some downside. Now, my view is that this move won't start motoring until late in Q1, but it's something to start paying attention to for the future, in my view. Now, let's get our calendar up. So, what do we have here? I want earnings. So, quiet-ish start to the week. I mean, we've got German retail sales, which should provide some inkling into what the German consumers doing. Naturally, Germany is the powerhouse in Europe, so should give a broader overview to how well the rest of Europe is doing. And I'm sure that the Eurozone data comes later. Unemployment rate, I mean, I don't really see unemployment rate as being that sensitive a data point at the moment. We know that unemployment has pretty much been decimated, and it's kind of distorted due to all of these different programs. If we look at Feb 2nd, we have got GDP flash preliminary year on year. Nothing really, and that's for Eurozone, nothing really else on Tuesday. Now, this could be an interesting data point depending on how far away from this is. If it's quite close, then I wouldn't really pay any attention to it. But if it does have some kind of deviation, and I would expect the deviation to be to the downside, considering the extent to Germany, France, etc.'s lockdowns, then that could really pose a question as to how strong Eurozone growth will be for this quarter. Key point here, ISM manufacturing PMI. One thing that a lot of people don't recognize about the ISM manufacturing, this is non-manufacturing PMI, still relevant, is that it's one of the biggest trend drivers in currency markets. It used to be NFP, but all the NFP does is make the chart look like a heartbeat monitor now. So it takes the higher range, lower range, finishes exactly where it started. Always note that with NFP. So it's one that you should always fade on the NFP. If it takes a key high, sell it. If it takes a key low, buy it. And normally you can, well, I say normally, you can try and catch both, but it's very difficult. What else have we got here? Yeah, this could be an interesting data point. Consumer PMIs, consumer construction PMIs. Seeing how well building's going on and investment in the UK. We do have the UK interest rate decision as well. I think that's on Wednesday, isn't it? Again, expecting nothing really too drastic there. It'll probably more be what they allude to in terms of QE, maybe some monetary policy, but I don't really see the Bank of England deviating very soon from their standard monetary policy. New Zealand retail sales there. And then we've got the NFP on Friday, of course. But do you know what? The problem right now is data seems to not matter massively. Okay, unless you're constructing a really broad view on data, it's something that can be a short-term volatility driver. But I think the bigger questions to ask are what are the disparities between the vaccine rollouts between different economies. Okay, what does that mean for forward earnings per share? So you can translate that into a trade on, different indices, and also what does it mean for growth prospects? Okay, these three factors are all linked, and they're the most important things right now, in my view. Cheers for listening, and speak again soon.